Right. So I was trying to give a bit of details into the discounted cash flow model and trying to use a basic business finance principle as an example, where I said that we know that the value of an investment is the potential returns that can come from the investment. Likewise, the value of a business is the potential cash that the business can generate. And so by the discounted cash flow model, what we are trying to do is that we are trying to forecast the potential cash flows from the business professionally, maybe 5 to 7 years. And then that is the first stage of it. And then the second stage is when you try to forecast it at a particular growth rate in perpetuity. And then you discount it to present terms because of time value for money. Because whilst you are doing the forecast, those cash flows that you forecast are going to be coming in years ahead. And so for you to be to apply the principle, you need to adjust those cash flows into present terms to be able to give you a true value, to be able to reduce the margin of error in your assumptions and all of that. Now, I told you that for the multiples, we try to derive the value of a business from similar companies. Okay, all right. So if we can be able to find the average of all the performance of a similar firm, of similar firms, of the same firm we are trying to value, then we can be able to have a relative value for the company in question that we are valuing. And so the example I gave is that, let's say we want to value Access Bank PLC. Now, you can be able to derive a relative value for Access Bank by looking at all the numbers of its similar companies. And by mean, let's say similar banks, but in terms of industry, similar banks. So you can look at GCB, you can look at StanChart, you can look at Societe Generale, you can look at ADB Bank, you can look at EcoBank Ghana, and then Bank Ghana as well. At least these are some of the banks that are listed on the stock market, and you can be able to generate a relative value for the Access Bank, which is the company in question that we are trying to find a value for right now. So that is all about the relative valuation, trying to derive a value for a particular company from similar companies already on the market. So, I mean, in other words, one would say, okay, trying to derive the return of an investment from a similar investment available on the market. So let's say you want to invest in a mutual fund, a new mutual fund has been introduced in the market, and you want to do an investment in that. Now, well, while you may not know what the outcome may be, you can be able to look at how similar mutual funds, let's say it's an equity, a solely equity mutual fund that is available now. You can be able to look at how similar mutual funds have performed. You can look at their numbers and be able to at least get a picture of how this new mutual fund that you want to make a decision on is going to be performed. So that is the concept of the relative valuation. So, you know, the term is relative, really trying to derive a value from similar firm. Just that. Now, back on our enterprise and our equity value. So our enterprise value, I established that enterprise value is virtually the entire value of the business, the net worth of the business, all of the business put together. How much does it cost? How much does it, can it be sold for, and all of that. And then the equity value I told you are the value of the traditional holdings in the company. So the equity value is basically the value excluding debts here. Now, for enterprise value, we have some multiples that relates to, or that are termed as EV multiples or enterprise value multiples, right? So if you know the typical business's financial statements, you know that we have the EBIT, we have the EBITDA, we have the gross profit level, we have the EBITDA, EBIT, and profit before tax, and then we have profit after tax. Now, what we say is that if you are calculating for an EV multiple, and then the denominator is before the interest expense, which is if it is before the interest interest expense, sometimes for some company, they will reference it at finance cost. If it's before that, then we say it's an enterprise value ratio. So for you to say that a particular multiple or ratio computation is an EV, okay, it's an enterprise value computation, or that multiple can be able to use to generate the enterprise or the whole value of the business, then you assuming that if the denominator or the device, okay, the divisor is below the interest expense of the account. So example is when you have EV over revenue, or EV over EBITDA, or EV over EBIT. So you know EBIT is earnings before interest and tax, EBITDA is earning before interest, tax, depreciation, and amortization. And so if the denominator is before the interest expense, then you can say that is an equity value ratio. Now, on the other hand, if the denominator is after, you say it's an equity value ratio. So for instance, price per earnings, price per book, price per cash flow, also price per earnings. Earnings is actually after the interest expense. Earnings, we mean earnings per share or profit after tax. Book value is actually the shareholders' equity or owner's equity in the balance sheet, right? So if the divisible is like that, then you can see that's an equity value multiple. And in the same way, if it is before the interest expense, then you can see it is an enterprise value ratio. So let us try to establish understanding here. So EV to sales or EV to rev. Now, at this point, typically it's just at the revenue, just at the gross level. You have not deducted your expenses. So here, one of the features is that here there is no cash. I mean, profit is not necessarily cash. So once there's no profit yet, you can't even start talking about cash. First of all, here you are looking at just the revenue side. So you are just looking at the top there. So it's you say that the pattern of sales, you are just matching it to sales. Sales is the first on the financial statement. So it's very clear to locate that in financial statement. But some of the issue is that it ignores the capital structure. This is not a balance sheet, it's just at the income statement. And we are saying it ignores the capital structure because it comes before the interest and tax. And so once the denominator is before interest expense, then you can see that it does not incorporate capital structure. And we also say it ignores the operating economics. So, you know, it is before some of the operating expenditures are deducted. And so, yeah, that's one of the issues with it. But then it is much recommended for companies with probably at the early stages, but then they are showing very positive outlook for you. So for companies like that, if you are using EV to sell something, you need to revenue multiple, then you may be on track, or you may be your margin of error will be reduced. For companies at their rapid growth level, I wouldn't want to cite local firms because it might it might ignite a debate into which company is at which growth stage and all of that. I don't want to get myself into it, basically. So yeah, for companies in rapid growth dimension, you can use this multiple. And EV to EBITDA, then EV to EBIT. So here, you know that EBIT, for instance, is virtually an operating profit. Here, some sort of expenses have been adjusted. And so it is much more better when used for companies at their maturity stage, or companies that are growing but at a slow pace. Then let's look at the equity multiple, which is the PE ratio. Here it incorporates capital structure, right? And it's good for companies at their late maturity or their early maturity. Both of them are good for it. So if you remember our enterprise value ratios, you realize that EV to sales is enterprise value, EV to EBITDA, EV to EBIT, they are all enterprise value multiples. By price to earnings, it's actually equity value multiple. So yeah, first of all, we have established that we for equity, if you are valuing equity in terms of multiples, you are looking at price to earnings, price to book, and price to cash flow. And then also for enterprise value, you are looking at EV to revenue, EV to EBIT, EV to EBITDA, and then sometimes EV to capital employed, depending on the industry. Now, for the free cash flow to we have the free cash flow to the firm, right? Which are basically the cash flows by the business and the financing costs, such as interest expense and all of that. And I mean, at the end of the day, you want to ask yourself, valuation suit what business, right? I mentioned earlier that the discounted cash flow is one of the widely used valuation approaches. And then, but then every company, every industry, and every company at a particular stage and what valuation approach suits them best, right? So until when you start practicing valuation, you on the job learn that look, these kind of multiples work, or this kind of valuation approaches work for this kind of companies compared to this kind of approaches. So basically, one thing I can tell you is that, for instance, if I am valuing a bank, even though discounted cash flow is widely used for most businesses, I am not much concerned about discounted cash flow. In fact, relative multiples works much for me better than using the discounted cash flow in terms of valuing the bank. And so when you start applying the valuation models on various type or industry type, you realize which ones best fit. Okay. Yeah, so for like a manufacturing firm, of course, discounted cash flow comes first in my head. But for a bank, I would choose the multiples or the relative multiples first. Now, I've seen people, I don't know, I hear people trying to speak. I don't know if any of us has a question at this stage, I'll get you into it. Any question at this stage? Please, do we have any question at this stage? Is there any confusion and all of that, so that we can proceed? This is just the introduction, and I understand that not every one of us here is in probably level 400, or is probably a finance student or a typical finance student. and has done basic valuations and all of that. So I wouldn't want to be doing or be going much deeper to, I mean, launch out a confusion and all of that. So if so far what we have done, the introduction, the rationale behind valuation, the various approaches, and then the bit of the principles, if there are any questions, you can just speak out so that I'll address it and we can move on. Hi, Emmanuel, do you have a question? Okay, it's fine. All right, please, you can speak, all right? The gentleman who has raised his hand, Herbert Kojo. Hi, Kojo, you can speak.
Yes, sir. So when you're presented with a typical financial statement, does that mean that you are going to always see the enterprise value and the equity value recorded in the financial statement? Or it's one of both?
Okay, all right. So these ones are not part of accounts. For equity, the value of equity is found in the financial statement. But in valuation, we use market values, right? So even the value of equity that you see in the financial statement is the book value and not the market value. So you see none of them. But if you were here earlier or in the earlier session that ended, I told you that the enterprise value is a combination of the equity value plus the debt plus and minus the cash, right? Or equity value plus net debt, where net debt is debt minus cash, okay? So you can find debt in the financial statement and you can find cash in the financial statement. And then the equity value is actually the market capitalization of the business, which is available in the on the market. So if you know the shares outstanding of the business and you know the current share price of the business, the current share price times the shares outstanding will give you the market capitalization of the business. Or I mean, once it is a listed stock, the market cap is readily available. They might not communicate it in the financial commentaries, but it's readily available on the market. You just have to check the share price, know the shares outstanding of the company, and then you do the multiplication, then you have your equity value. And then out of that, you can be able to compute your enterprise value or fair value or EV. I don't know if I have made myself clear.
Yes, sir. Thank you.
All right. Any other question? Then we can proceed. Hello. All right. So if you don't have any other question, then I want us to look at where you want to value a business. So we have not delved deep into the discounted cash flow model. I just want you to have the concept that with discounted cash flow model, we try to So I just wanted you to get the concept that with the discounted cash flow model, we try to forecast the business's cash flow into the future and discount it into present terms to be able to estimate the value of the business, okay? And then the relative multiple is trying to combine the numbers of similar companies on the market and then derive a relative value for the company in question that you are valuing. So for subsequent meetings, we'll be looking at each of them one after the other. So discounted cash flow, where we try to build a DCF model and forecast the financial statement into the future for somewhat 5 years or 7 years, and then derive a value as we are supposed to do. So get the concept behind the valuation approaches, the DCF. We are moving on to the comparable company analysis or relative, which is also a market approach or a relative valuation approach. So with this approach, it involves selecting similar companies in the market and then deriving a value for the company in question. So I was using the bank as an example. And so, for instance, if you want to invest, if you want to value Access Bank, there are a number of banks in the market. You can pick those banks and then combine their values. You can pick the average and say that, okay, if averagely a bank goes for this amount, then this can be that of the bank that I'm trying to value. So one of the advantages is that, first of all, it is rational in the sense that, like the bank example, if you believe that investors are willing to pay, let's say, 5 Ghana cedis for GCB Bank shares, then you can be able to infer that comes to say that, okay, well, then they may be willing to pay 3 cedis for Access Bank. Do you get it? Yeah, so that's the rationale for the relative valuation. Because at the end of the day, you look at the size of the company and the analysis and all of that. So let's say if GCB, which has over 180 branches, okay, investors will be willing to pay, let's say, 5 Ghana cedis. Then you can say that Access Bank, which has under 100 branches, investors may be willing to pay, let's say, 4 cedis, right? So it makes sense. Now, another advantage is that, for getting similar companies, most of the time it's easy to get. Like for several, if it is manufacturing, you can easily get. Like on the market, if you are working on pharma, you need similar companies. There is Guinness, there is Benzo Oil, there is Unilever. If it is a bank, there are about 8 banks. Even though our market is not that big, you can still have similar companies, right? Yeah, so another thing is that you'll be able to gather their current number, their current status, and that makes the valuation more reliable, right? And another thing is also that sometimes you can have a large pool of companies, okay? Even though we have a small economy or a small space here, for instance, there are 23 commercial banks. Just assume if all of them were listed and you want to value a bank, a new bank, you have up to like 23 commercial banks to do the relative comparison. Now, some of the advantage of the trying to value a company with similar companies is that, first of all, no company is the same as the other. Every company is unique in a particular way. So we say no perfect comparable. There's no way a company will be the same as a particular company. So what we do is that we rely on factors like industry, factors like asset size or market cap, those things. You get it? So by virtue of them being in all those companies being in the banking industry, then we say they are comparable. But frankly, if you go deeper, GCB is different from Access is different from Society is different from EcoBank, different asset size, different liability base, different depositing structure, different business approaches, and all of that. And so that's one of the disadvantages of trying to derive a value of a business from a similar company. Because first of all, there is no perfect company or perfect comparable. And so you just be doing it based on some of these factors, external factors like that, by virtue of them being in the same industry. Another thing is that sometimes it's hard to adjust the growth. Okay, it's hard to value the management team and other factors of the business. The fact that the similar companies are growing at a particular pace, sometimes to exercise the judgment, professional judgment, that by virtue of this business should grow at this level is also a difficult thing. And then another thing is that it may be easy for you to fall into the value trap, overvalue fallacy, whereby maybe at the time of your valuation, all the similar companies that you are going to pick, they may be overvalued on the market. right? Investors may be overvaluing them. And then you go and pick them and use their averages to do your relative valuation for the company in question. At the end of the day, what happens is that, you see, you may overvalue the company that you are valuing, like the company in question. And that's one of the disadvantages. You get it? Yeah. So that's the advantage and the disadvantage with applying the comparable company analysis. So, like I said, each of the company valuation methodologies have their own pros and cons. And at the end of the day, a combination of 1, 2, or 3 reduces your margin of error. So here is a sample of a comparable company, right? So where they look at the company here, this type in question is, let's say, micro partners. Now, the similar companies we have in the market is, let's say, junior enterprise, mature enterprise. So let's say in Ghana, we are using a bank. If you want to value assets, the similar ones are GCB, they are EcoBank, they are Stanchart, they are Societe Generale, they are ADB Bank, and all of that. So you realize that for markets, they look at, for instance, the prices of their shares outstanding, they calculate the market capitalization, the net debt, which is the debt minus cash, and then they are able to calculate the enterprise value. And then for the financial, they look at their revenue, look at their EBITDA, their earnings, and then valuation, we do the EV sales, EV, EBITDA, and then the price to earnings. And then you can be able to generate the mean values. So once you have the mean values for them, you can be able to derive a value for the new company. So practically, if you are performing a comparable valuation, this is how your sheet may be looking like. Where you pick similar companies, about 4 or 5, and perform it. So today I want to gist you on how you can perform comparable companies, right? And then we will call it a day. I will gist you on how you can perform comparable companies. So for the Ghana Stock Exchange, there are 2 broad sectors with better comparables. One of them is bank, and then the next one is manufacturing. Okay, so if you bank, there are about 8 banks listed. So you can get about 8 banks to compare. And then if it is FMCG, or let's say manufacturing, there are also about 5 companies. So we are going to be glancing through how you can go and list a number of companies and gather their numbers. So the example I showed you, they gathered the price, the shares outstanding, price times shares outstanding is the market cap. The net debt is the debt minus cash. And then the enterprise value is the market cap, which is the equity value, plus the net debt. That gives you the enterprise value, right? So after here, I expect that we all get to the market, try to pick the financial statements of similar firms, combine them, and compute for some of these valuation metrics. So first of all, you have to go to GSE or the company's website, where you can find historical financial data, where you can get on the GSE website, you can find the share prices, the shares outstanding, and all of that. On the company's website, you can find other information. You can also find the financial statements. Okay. The second thing is that you download the financial data. So on the company's website, you can find the company's account. The most recent, let's say 2023, let's not use quarterly, 2023 full year would be available on the company's website by now. So you list the companies you want to use as comps. Start computing. Hi, Cindy. Yeah.
Yeah, so it's left with 4 minutes, then today's meeting, and like you can't join again because the meeting was for 80 minutes.
All right. So
Maybe
this
around
actually, this is
500.
actually our last set for today.
Oh, okay, sure. So after 12,
Okay. All right. So yeah, so get to GSC website. First of all, decide, are you doing banks or you are doing FMC or every other firm? You can do mining and all of that. So go to the GSC website, get the share prices, get the shares outstanding and all of that. I mean, I can share it to you guys readily. I have it readily available, but you have to do it all by yourself so that you get conversant with some of the platforms.
Hey, the good and you will get it.
So the next thing is that you have to go to the company's website and download their financial statement historical, right? Download at least their 2023. For the comps, you need the most recent data. And then the next step is you build a table where you calculate the market cap, the EV, all the ratios and all of that, like I showed to you in this page, right? You do the computations. And then at the end of the day, by finding the averages, I mean, can be able to also compare whether the company's multiple is above average or below average and all of that. So that's a comp schedule for your ready for your valuation. That's what I expect that after this section you go and do. So let's go and build a comp schedule for evaluation before we meet in the next section. So I'll end here. If you have any questions, just raise your hand or you can just unmute yourself and then speak.
Yes, sir. Which company would you suggest we go with to make it easier for us? Like a basic company whose statements are easy to work out.
So this is comps. So you need I expect you to show about 5 companies. You are doing comps. So I expect that you show about 5 companies. So if it is banking, first of all, like I said, the factors for selecting similar companies are, first of all, industry. By virtue of them being in the same industry, or maybe the market capitalization. But let's focus on industry now. Let's use industry as our main factor in selecting similar companies. So banks, we have about 8 banks. Access Bank is 1, GCB is 1. So build a comp schedule for at least 5 banks listed on the stock market. We have Access Bank, EcoBank, GCB, Stanchart, ADB, which is Agricultural Development Bank, Societe Generale Ghana. Yeah, we also have Trust Bank Gambia, which is not a local bank, but they're also listed. So build a 5-company comp schedule, like I'm showing it to you on the screen right now. Calculate find their share price, their shares outstanding, their market cap. I mean, and then also the financial side, you can calculate and it's not like calculating, in fact, the sales or the revenue or revenue or income is readily available in the financial statement. So when you just pick the revenue in the financial statement and put it there. If it is a bank and you are not seeing revenue inside, I want you to do all this by yourself. Google what the revenue of a bank comprises, because when you go and download the bank's financial statement, most likely you will not see a revenue. You will see like interest, income, fees, and commission and those things. But try and then search what revenue entails for a bank. It includes 3 things. Okay, so which is the net fees income, the net interest income, and then the trading income, right? Yeah. So you can be able to add up and get the revenue for it. And then the EBITDA and all of that. Try and then I want you to do, more work. So that you get conversant with everything, right? Yeah. So let's do banks. Okay, let's all do banks. I don't want us to stress. Let's all do banks. 5 banks in the schedule. Let's calculate the ratios and then let's do the averages. As simple as that. you good?
Yes, sir.
All right.
Thank you.
Okay, any other question? We have a few minutes to end the Zoom, so we have some 12 minutes. Any other question? I mean, or if you have a contribution, so you can. It's allowed.
So the format, the work we are producing, it should follow the formats which you are projecting right now on the screen.
Exactly. You should follow this format, but you can, there are more extensive, there are more longer tables than this, right? But let's focus on these ones for now, at least these ones for now. Let's focus on this. So like we have the price to book ratio, which you can also compute and add. I mean, if you find in your research, you find more ratios, extend it and add it. That would be an additional plus. I mean, we are learning, we are trying to be finance professionals. And so once we find something interesting, let's not, settle for just what we have been taught. Let's be interested, let's be curious in our search and all of that.
Okay.
All right.
Please, will the slides be made available to us?
The slide is not complete yet. We are not done going through everything that we are going through. But I'll try and take the shots of this thing and send it to you. So let's
Very
do
well.
that. Okay. Whatever you do, I have a database for it. So if any of us go and let's use 2023 financial results. If we go and conjure any figure, we will know. So let's try and download the 2023 reports. If we haven't done that for in our lifetime, let's try and first of all download a real company's account and then start working with it. Because when you become an analyst or when you be getting into the finance industry, you'll be working with a real statement. Yeah, so let's start from here. This is our first session. We might not be doing a lot of complicated stuff. Let's start from there, and then we will all be fine. I presume every one of us is okay, like okay for tonight's session. We have just 1 minute, so in the absence of any question, I think we can call it a night. All right, so thank you so much for making time to join this session. I hope you found it insightful. I pray that you make time for the next section also.